You ever wondered why the rich invest in real estate in the first place? Let me let you in on their little secret. It has to do with taxes. So, what if I told you that you could not only grow your wealth through real estate investing, but also significantly reduce your tax burden? Well, in this video, we're going to unveil the 7 tax benefits of investing in real estate that the wealthy use that you can save thousands, maybe even 10,000s or more over your career. If you're new here, I'm Dr. Jeff Angelon, a periodontist, not a tax advisor, so make sure you consult with yours before you use any of this information. Do me a favor and download the free passive income guide with the link below this video. Investing in real estate has been widely known by the rich as a great way to build wealth because it gives them a chance to make passive income, diversify, and take advantage of the market growth. However, one of the most overlooked advantages is the significant tax benefits that real estate investing gives you. Let's get into those 7 now. Number 1, when you invest in real estate, you typically intend to sell the asset for more than you purchased it, right? This is called a capital gain. The formula for this is the selling price minus the purchase price. That is your capital gain. The IRS taxes these gains, but how much you pay depends on how long you've held the asset. So if you sell an asset after owning it for less than a year, that's what's called a short-term capital gain. And it's actually taxed at your ordinary income rate. If you hold an asset for more than a year, that's a long-term capital gain, and it's actually taxed at a reduced rate, potentially as low as 0% depending on your income. This really incentivizes long-term investing. Number 2, we've talked about this a lot on this channel, is depreciation. One of the biggest tax benefits of investing in real estate is depreciation. The IRS knows that property wears down over time, losing value in the process called depreciation. Now, for tax purposes, you can actually deduct a portion of the property's cost each year as a depreciation expense. There's actually 3 types of depreciation: the straight line, accelerated, and bonus. Each type allows you to recover your investment over varying timelines, reducing your taxable income along the way. So let's briefly talk about the 3 types. The first one is straight line depreciation. Residential rental property owners can actually depreciate their property, straight line depreciation, over the course of 27 and a half years. For example, the annual depreciation expense, if you went out and you bought, let's say you bought a single family home, you want to turn it into an Airbnb, you want to rent it, it would be depreciated. You take the purchase price, 300,000, multiply by 27 and a half. So you're able to depreciate 10,000, almost $11,000 every year over the 27 and a half years. Second is accelerated depreciation. Property owners can go out and they can hire an engineering group to perform a cost segregation study. This group, they actually segregate out different building components, not just one component over 27 and a half years. They know that there's other things that will wear and tear, that will break down less than 27 and a half years over shorter time schedules of 5, 7, and 15 years. So this is accomplished by, they go in and they identify the non-structural elements plus any land improvements like flooring, appliances, cabinets, parking lots, etc. If you're a real estate investor and you get this done, you actually receive more of an upfront depreciation benefit because accelerated depreciation creates larger paper losses in the early years of you actually owning the property. The third type of depreciation is something called bonus depreciation, which allows you to front load the depreciation even more. Now, by using this, you can immediately depreciate the items with less than a 20-year life in actually the first year. All right, the third benefit in investing in real estate, probably something that you've heard of, it's called the 1031 exchange. Named after Section 1031 of the tax code, this tool lets you defer capital gains tax when you sell an investment property, and then you reinvest the profits in a new property. Here's a catch. That new property that you have to buy, it must be like or kind. It's called a like-kind exchange, meaning similar in nature and character. There are strict timelines and rules for this process to be done correctly, but when you do it correctly, it allows for continuous investment growth without immediate tax obligation. So some of the rules are you exchange or you sell one property for another, that like kind. So it must be real estate for real estate. The replacement property must be equal or greater value. You actually have 45 days after you sell your property to identify up to 3 new properties, and you've got 180 days to close on one or more of the 3 identified properties. Now, you must use what's called an intermediary to help, which means that all of the funds, whenever you sell the property, they go to this neutral party. So you're, in essence, you're not ever, you've probably heard the rich, they never sell their property. They're not selling it. They're always just exchanging it. So they never receive the profits. They just keep exchanging it, keep deferring those capital gains tax. Number 4, you actually get tax benefits of refinancing. So whenever you refinance your mortgage, you can potentially access several tax benefits. So the interest that you pay on your new loan, it actually remains tax deductible after you refinance, similar to your original mortgage. Now, you can also deduct points and points that you pay during refinancing, which are prepaid interest. Additionally, if you take out a home equity loan or line of credit for, let's say, home improvements, the interest may be tax deductible. Remember that tax laws are always changing. Make sure you check with your tax professional before you, again, implement anything that we're talking about today. Number 5 is opportunity zone investing. Now, the Tax Cuts and Jobs Act established opportunity zones throughout the U.S. to spur investment in economically distressed areas. By investing your capital gains into these opportunity zones through a qualified opportunity fund, you can actually defer and potentially reduce your capital gains tax. The longer you hold your investment, the greater your tax benefits. So just like the 1031 exchange timeline, the qualified opportunity zone investment program must also meet certain requirements. Within 180 days of the sale of the property, the capital gains must be invested and needs to be exchanged for equity interest and not debt interest. Now, the time period in which the investment is held actually determines the amount of the tax benefit that you will receive. In addition, if you hold an investment in a qualified opportunity zone fund for at least 5 years, then you're going to get a 10% reduction in capital gains. If you hold for at least 7 years, you get a 15% reduction. Once you hit that 10-year mark, the basis, the cost basis can actually be adjusted to its fair market value on the day that it's sold or exchanged. The 6th way is the 20% pass-through deduction. Now, this tax benefit, also created by the Tax Cut and Jobs Act, lets eligible self-employed individuals and small business owners, including many real estate investors, they can actually deduct up to 20% of their qualified business income. This can significantly lower your taxable income and therefore your tax bill. Business owners that are sole proprietors, LLCs, and S Corps with taxable income, if you're single, less than about $170,000 or about $340,000 if you're married, filing jointly, they'll be able to deduct 20% of their qualified business income. So, for example, if you have a business with a net operating income of $100,000 and you have W-2 wages of $100,000, then you can deduct $20,000, 100,000 times 20%, you can deduct $20,000 from your NOI, or your net operating income. If you're actually over that income limit, then you start getting into some complicated IRS rules. So again, check with your CPA. Last but not least is the short-term rental loophole. Now, this is a lesser known yet very powerful strategy that has been actually hiding in the tax code, as it actually defines certain exceptions to what's considered rental activity. Typically, rental income is seen as passive by the IRS, but these exceptions actually allow it to be classified as active income under certain conditions, thus opening up the possibility of write-offs that wouldn't usually be available for passive income. So there's actually 6 conditions under which a property's income can be excluded from the definition of rental activity. But the main one is that the average period, the average customer stay in the property is for 7 days or less. Let me give you an example. Let's suppose that you purchase a beach house for $500,000 and you rent it out on a short-term basis Average customer stay is, let's say, 5 days. Okay. You're also actively involved in managing the property. You're materially participating, which makes you qualify for this loophole. In your first year of ownership, you get a cost seg study and you're able to actually accelerate $20,000 of depreciation that first year that you would ordinarily have to spread out, remember, over the 27 and a half years, straight line depreciation. In that same year, let's say that you rent it out, you do Airbnb, and it actually generates $30,000 in rental income. However, when you factor in all your deductible expenses, mortgage interest, taxes, insurance, maintenance, and that accelerated depreciation, let's say your total deductions come out to be $40,000. Now, normally with a passive rental activity, you could only use that $10,000 loss, the 40,000 in deductions minus your 30,000 income. Normally, you could only use that $10,000 to offset other passive income, such as maybe from other rental properties. But because of the short-term rental loophole and your active participation, you're materially participating, you can actually use this $10,000 loss to offset your active income, your ordinary income, which could be from your practice, your business, or even investments. So let's say you're in the 24% tax bracket. So that 10% loss could actually equate to $2,400 in tax savings. You take 10,000, multiply by 24%. That's money right back into your pocket thanks to this loophole. Again, it's very important to consult with your CPA or your tax professional who is knowledgeable in real estate before making any decisions on any of these tax benefits. Okay. Now, if you want to learn about one more tax loophole that you can actually use with your primary home called the Augusta rule, check out this video.